Most employees don't think about life insurance until it's too late. As an employer, you have a chance to change that by offering something that could protect their family for a lifetime. In this video, we'll break down how whole life insurance works and why it might be a powerful benefit for your team. Stick around until the end because we'll not only clear up some myths, but also help you figure out if whole life really fits your workforce or if there's something else that might make more sense. So you're thinking about offering life insurance as part of your employee benefits, but you've probably heard things like whole life is a bad investment or it costs too much. Let's cut through the noise and talk about what whole life insurance actually is, what it offers, and how it works, and why it might make more sense to your team. Whole life insurance is permanent. It lasts your entire life as long as the premiums are paid. That's different from other types of policies like term life that might expire after 10, 20, or even 30 years. With whole life, we're talking about a long-term financial tool, not just protection, but also a way to build value over time. Let's break that down. Whole life insurance has two main components. First, the death benefit, which is the amount paid to your loved ones when you pass away. That's tax-free and guaranteed as long as the policy is in force. Second is the cash value, which is where whole life stands out. Each time a premium is paid, a portion goes towards building this cash value. It grows over time and is guaranteed to increase year after year. Later in life, that cash value can be accessed either by borrowing against it or using it to help cover premiums or letting it continue to grow. It's like a savings component built into the policy. And one of the best parts, the premiums never increase. That means what someone pays at the age of 25 is the same amount they'll be paying at age 45, 55, and beyond. No surprises and no rate hikes. Some people use whole life as a part of a long-term financial plan, especially if they want something stable and predictable. Others like knowing it's always there no matter what life throws at them. There's peace of mind in knowing the policy like this won't disappear just because someone changed jobs, got older, or even experienced health issues. Now, let's clear up some of the common myths. One of the biggest, whole life is a bad investment, but that really misses the purpose. It's not meant to replace a stock portfolio or a retirement account. It's meant to protect a person's family while offering a layer of financial flexibility. Someone might be perfectly healthy today, but no one knows what tomorrow brings. And if there's any change in their health, they may not qualify for coverage later on. Another one we hear a lot is, I'll wait until I'm in a better financial position. But here's the truth. The younger and healthier someone is, the lower the premiums will be. Locking in those rates now can make a huge difference over time. So while whole life isn't right for everyone, for the right person, it could be a smart long-term move, especially for people who value predictability and lifelong protection. As an employer, offering whole life insurance as part of your benefits package shows your team you're thinking beyond the basics. You're not just covering today, you're helping them plan for the future. And in today's competitive hiring market, those kinds of benefits matter. They show your employees that you care about their families, their long-term financial security, and their peace of mind. Thanks for watching. I hope this helped you better understand whole life insurance and how it can fit different employee needs. Take care, stay safe, and I'll see you in the next one.